In the game of loans, you either win or you learn. Welcome to the game of loans, where fortunes are forged and empires are built. Your hosts, lords of lending and wholesaling, are here to guide you through the realm of real estate and wealth building. Brace yourselves, cash flow is coming. This is episode 4 of the Game of Loans. In this episode, we're going to be responding to questions from people in the audience that they may have on real estate investing. So, let's go.
Right, awesome. First question is, what is real estate investing and how do I get started?
I'll take that one. So, real estate investing is what it sounds like. It's buying real estate in different forms. It could be residential, meaning that people actually live in the home. It could be commercial, which means it could be office buildings or anything service related, or let's say it could be like a strip mall or anything of that sort. There's industrial, which is exactly what that means, which is industrial space. People could use it for, what would you say?
Warehouse.
Storing, warehouse, or industrial could be chemical space. People creating chemicals or things like that, or it could be like creating tchotchkes or things like that. So that's real estate investing. I always recommend that anyone that wants to get into real estate, first thing that they do is start with small residential, and then you could graduate into different types of real estate if that's going to be your focus.
How much money can I make from real estate investing? Please give me examples.
You want me to take that one?
You take that one.
You can make pretty much as much money as you want as long as you find a good enough deal. And by deal, and like Steve said, starting with, if you're starting out, small residential properties, if you're going to do a fix and flip, which is where you're going to make your fast money, your large amounts of money, which is, I think, when people think real estate investing, if they're not thinking rentals, they're thinking big checks. So it really depends on how good you are at finding the deals off market, direct to seller, how you're acquiring these, getting these houses for a very, very low dollar amount, learning how to fix them up and then sell them for max profit. You can make some huge licks. For instance, I do mobile homes a lot, and I've not sold a mobile home that's made me less than $70,000 on the backside once it's done. So, and same thing with single family homes, and you can do it with land. You can do it with anything.
I would do some more mobile fucking homes.
Yeah, man, mobile homes are in right now for me, man. They're gold mine. So if someone calls me with a mobile home and land, I'm like, when can I see it?
Call us. Next one. Go on.
What are the different types of real estate investment, and which one will be best for me, a beginner?
Well, the different types of real estate investing, typically you have different asset classes that Steve alluded to earlier, residential, multifamily, which is a hybrid commercial residential, and true commercial, office, retail, industrial. The types of real estate investing, if I'm understanding correctly, are going to be based off of your exit strategy. So you can acquire real estate to renovate it and hold it and keep it as a rental property. It could be a property you acquire and it's already turnkey or ready for somebody to move in, that you can cash flow immediately. There are properties you acquire to renovate and sell. There's land that you can acquire, entitle, and then build upon and then sell or hold. And then you have properties, where you purchase, for a certain use, like a house here in Nashville that may be zoned for multiple houses, where you knock down the existing structure, and build multiple properties there. So there's a number of different types of real estate investing that you can get into. Backing up to, the beginner level, the easiest thing for you to get into is to buy your first piece of property as your primary residence. If you have the income and qualifying credit score to qualify for a property, I highly encourage you to buy your own house. And then once you have that property, if you decide to purchase another property, you can then rent that property out, That'll become your first rental property. You move into your second primary residence. You're now managing 2 properties. That's a good, starting point for most people to understand what it takes to own and manage their own property, then to own and manage a rental property while managing your own primary residence. And then I would say from there would be getting into, flipping houses would be kind of the next, stage. If you're not, comfortable on the wholesale side, buy something, renovate it, sell it. Ground up construction, would probably be the most difficult out of all the different types of investment. Although I think ground up construction is one of the safest investments in today's market, but it takes the right person with the right level of experience to understand how to go through that process.
I think another thing that comes with, flipping, buying and holding, all that is, raising private money too. That's another big one. Is you can easily run out of money if depending on how much volume you're doing. So it's always good to have multiple aspects when it comes to in real estate investing. So.
Yeah, that's why I encourage people to get their own primary residence, because you're going to get the highest percentage of financing against that purchase price.
With the best rate.
You can get a 0% down payment if you're VA or USDA. FHA financing 3.5%. Government financing with private mortgage insurance, you can get as low as 3% down. So it's the lowest barrier to entry from a down payment standpoint, although they do focus on your income and credit more than other options out there in the market. And you're going to get a lower rate than going out and getting private money or hard money, sure, or, borrowing money from family and friends. So that's the best way to get started. That's how I got started in real estate. I bought my own property myself. I put a tenant in there, moved into another house, tenant, another house, tenant, another house, and then finally got into the private lending space and real estate investing space, where I was acquiring property, adding value through renovation or building, and then either selling that property or, keeping it as a long-term rental.
Good. Okay, how much money do I need to start investing in real estate?
I think I just touched on that. There are options out there for you to acquire your own property with as little as 0% down. But that needs to be, a rural property that qualifies under USDA, or you need to be a veteran to be able to go out and get the VA financing. But for any normal consumer out there today, you can get into a mortgage, with as little as 3% down. You can request closing cost assistance from the seller to cover all your other closing costs. You can get the down payment gifted to you by a family member or friend. So really you need nothing. You just need to be resourceful, and you need to be able to have the right amount of income to be able to qualify for that payment, so that you can qualify for that as your primary.
You could even get the 3% or 3.5% from some government grants.
Yeah, down payment assistance program.
Down payment assistance program.
Yeah. Now if you're going to buy your first true investment property and you're not willing to move into it as your primary residence, you're typically going to need somewhere between 20 to 25% down to buy an investment property. So depending on what price point, if you're buying a $100,000 house, that's 20 to 25K down plus closing costs. If you're buying $1 million property for your first one, that's $100,000 plus closing cost. $200,000 plus closing costs. So depending on how much you have saved up should determine what price point you're going out and acquiring. And the other thing to just factor into is, if you're buying that to just hold it as a rental, is make sure you have positive cash flow and you have reserves available, that in the event the tenant moves out or there's repairs that need to be made or your rent doesn't cover your mortgage payment, that you have the reserves to help you, sustain that payment. And I typically tell first-time investors, and our underwriting requirements on this is typically 6 months payments in reserves in their bank account when they acquire the property, on top of all the closing costs and down payment.
But that's the minimum, right?
That's the minimum.
What you're usually recommending, 12 months.
12, yeah.
Right.
Good. Okay. So what is real estate wholesaling and how does it work?
Real estate wholesaling, real quick, is basically buying and selling property without using your own money. You're not utilizing banks. You're not utilizing private money. You're using no money. All you're using is what's called equitable interest, which is basically signing a contract with someone and making an agreement stating that you are going to give a seller a certain amount of money for their property and close within a certain amount of days. Now, wholesaling is one of those great entry level, I call it elementary school, or even preschool, when you're in the real estate investing bracket. So it's if you have no idea where to start and you have no money, I would definitely recommend starting with wholesaling. Even if you don't do that many deals, it's a great way to learn. But essentially, you're able to sign a contract with a motivated seller, getting a house under market value, usually within 60 to 70% of the retail value of the house. And then you are taking that contract, stating, like, say I got a house for $50,000, but it's worth $150,000. I can go and take that contract and find another buyer for the property. I'm not a real estate agent. You don't have to be licensed. I am just a individual investor, and I'm taking that contract and I'm assigning, almost trading my rights and interest to buy that property to somebody else, going, well, hey man, I don't have the capital to buy this property. I don't want to buy this property, but you do. I'm going to give you the equitable interest that I have in this property. I'm going to give it to you, but you're going to pay me for it. And I'm signing another contract with them, making them the new buyer. So if I have it for $50,000 and sell it to them for $60,000, I'm making a $10,000 middleman fee, and I don't have to do any work. I never had to bring any money to the deal. I didn't even have to pay any closing costs. I did nothing. I didn't even sweep a broom. All I did was find a deal, find a buyer, facilitate it, get it to the closing table, and then I slide out in the middle. So if you're getting started, that's one of the best ways to gain some cushion in your bank account and get some capital.
Awesome. How do I evaluate a property to know if it's good? If it's a good investment? Please repeat the question.
How do you evaluate a property?
To know if it's a good investment.
Well, initially, I mean, you have to evaluate it yourself. Just look at the property, look at the roof, see if it needs a new roof. That's really important because that could cost you some money. Look at the bathrooms, look at the kitchen, look at all that stuff, and evaluate it to make sure that everything is, in working condition, and how much it would cost to change that stuff if it needs to be changed. The other valuation, obviously, when you go for a loan, is going to be an appraisal, which is a objective price that appraiser is going to go out there and they're going to do comparables, meaning they're going to find similar properties with similar traits, similar square footage that have sold recently.
That are right around that house.
Usually within, depending on where, right?
Yeah.
If it's not a rural area or
right.
places like that, it's going to be, within half a mile, maybe a mile. And they're going to use those comps, those comparables to give you an accurate gauge of what that property is worth.
Yeah, it used to be that, sales data was hidden from the consumer. We're in in today's world, we have access to tools and resources like Zillow and Redfin, where you can essentially go set filters. Let's just say you're buying a 3-bedroom, 3-bath house that's 2,000 square feet. It's built in 1980. You can literally set filters, and I like to stay within like a 10% range of the property that I'm looking at. Draw a circle around the subject property within the desired radius. Half a mile is suggested, but in some cases, depending on how similar the comps are, you may need to go a little wider. And you can literally click through and see what these houses sold for in the last 6, 12, 24, 36 months. And then you can look at the condition of the property, whether it's as is or remodeled. Now, some states and areas restrict the sales data, like Texas is one of those. Some places in Georgia, it's not public information after the property is sold. But in most markets that you operate in, you can see all of these closed comps. And if you use your, reasonable judgment, this one sold for $2, this one sold for $210, this one sold for $150, but needed, X dollars in work, you can generally get a good range of what you should pay for that. And then you have the appraiser coming over the top to kind of validate, the offer that you paid for it. But sometimes when you're buying from a wholesaler, you don't have access to an appraiser. If you decide to go through private financing that doesn't require a full appraisal, because there are lenders out there that will do that. But I suggest, if you're a new investor, have an appraisal to help you support that, because if you missed out on the offer price and it comes in lower, it'll be an opportunity for you to renegotiate with the seller or tell them, go pound sand, put it on the market and see if you can get a higher offer. Usually, your engaged buyer is your best buyer, because there's carrying costs for them. They have to pay interest, taxes, insurance. And so they're motivated to sell. As long as your valuation is reasonable, they should be reasonable in renegotiating that price.
Okay, intermediate questions. What is the difference between flipping houses and buying rental properties? What will be better for me?
So I know Ross said earlier that you would probably get into rentals before flips. I'm more of a get your fast cash going first before you get to the slow money, because I feel like a lot of people. So to answer the question, flips are where you buy a distressed property, and sometimes it doesn't even have to be distressed. And you go in there and you might do some minor repairs, you might do some major repairs, but you're buying it under market value, you're making repairs, and then you're reselling it on the market and making a profit from the spread of what you paid for on the market, from the money you put in rehab costs until what's left over. And then rentals are essentially, you're doing the same thing. You're buying a house, maybe it needs some rehab, a lot or a little, and you're fixing it up, making it nice, making it move-in ready, and you're putting a tenant in there, and you're making that passive income. So instead of making that big chunk of change, you're making small amounts. Whether you pay cash for it or you leverage the banks or you leverage, loans, you're still making money gradually every month. I recommend doing flips first because I like to have that safety cushion. I want to get really good with doing rehabs. I want to make sure my fast money is consistently coming in, and then I want to cherry pick my rentals, the ones that I'm getting over 1% back. I'm getting 2%. I want the really, really good returns. So if I can't rent it, or if I don't want to rent it, I'd rather flip it or wholesale it, and then just cherry pick my rentals. So I would say wholesale, flip, and then rentals. That's just my opinion.
No, I agree with your approach. My comments earlier were how to get in with as little money as possible.
Oh, gotcha.
Flipping does require significant resources.
Yes.
You have a much higher down payment, and you need to have the capital to actually progress through the project. And then there's the expertise side of it, finding a good contractor, building that rapport.
Yeah.
But anybody who's trying to get into real estate investing full time and wants to be able to properly run their scenario through a waterfall, where what is the optimal exit for every property, you need to know how to evaluate an acquisition, you need to know how to renovate a property, and you need to know how to manage a rental property. And as you get a property, like a wholesale deal, and we see deals all the time off market, sometimes we have to take back properties. I'm looking at, okay, what's the highest and best use for this thing? Do I renovate it and cash flow it? Do I renovate it and sell it because there's tax consequences, capital gains taxes if you're not doing a 1031 exchange? Or do I wholesale the property and not put any sweat equity into it, try to make a margin and get rid of it? And that's where you have to have a model built where you kind of run all the scenarios and see, if I renovate and put $50K into this, it's going to be worth $100,000 more, and I'm going to cash flow positive on the refi at X dollars a month, and I'm going to be able to pull my cash out. That's the perfect scenario where you don't have to sell the property, you pull your down payment back out, and you're still cash flowing.
Right.
And that's how we're looking at the top of the list here. Then if it doesn't cash flow, or I'm not going to be able to recoup my down payment, I may want to recycle my profits and take some profit, pay some taxes, but have a bigger pool of money to go out and acquire more properties with. And then if it doesn't make sense to renovate it because the upside's not there, you probably shouldn't have bought it in the first place. But if you already own it,
right,
you're trying to figure out what to do with it, it's probably best to wholesale that and try to make a spread on it and pass it to the next guy.
Right.
And then there's other, scenarios where, you might have to fully write off a property. It's not worth what you owe on it. Those are the tough situations that, unless you're doing like large scale investing or investing in really lower income, lower value neighborhoods, you typically don't run into that. But in 2012, the hedge fund I worked for bought 3,000 properties, at an average of $5,000 a property from Fannie Mae. And we had to go through and evaluate what's the highest and best use for these. Some of them, we deeded them back to the city and they went to the land bank and they were sold to other investors 5-10 years down the road. Some we demoed and we sold the land. Some we remodeled. Some they were habitable, so we put a tenant in them and cash flowed them. Some of them we did an owner finance contract where they were able to demonstrate their cash flow, and then we did an FHA refinance and we're able to recoup full market value for it. It was a killer investment for us, but I got to see the really dark side of the real estate market when we were giving away houses or selling houses for a penny.
Yep.
All right.
I don't think we're going to be there anytime soon, but if we end up in another 08 type scenario, that's where I earned my stripes. I was a garbage man, but slowly moved up the spectrum in value, and I found my sweet spot where I like investing, and that just happens to be, in the $500 to $1.5 million range. The type of property you get, the quality of the property, the quality of the tenants are just a lot easier for me to manage with everything else I have going on with my life. If I wanted the highest cash flow, I'd be out there probably chasing Section 8, lower income, higher cap rate type stuff. But for the amount of time I have to spend on that side of the business, I just like the peace of mind.
And I also think it's what to answer that, it's where are you in life? If you're just going to be full-time in real estate, obviously what you guys said, but if you're a part-time guy and you're just looking to invest, it's all day, go get rentals, because you're not going to have time to fucking flip homes.
Yeah.
So
Okay. How do I finance my first rental property? Please repeat the question. What I was going to answer.
how do I finance the first rental property? Well, again, I think Ross had said earlier, there's two options. If you want to go out the traditional way, then you're going to have to put anywhere between 20 to 25% down. And then you could get what's called a DSCR loan, which is a debt service coverage ratio loan, meaning, how much am I collecting and what's my payment, right? So if I'm collecting 1,000 and my payment is 1,000, that's a 1-0, meaning it's even. If I'm collecting 1,250 and my payment is 1,000, then my ratio is a 1.25, right? So obviously the higher the ratio, the better it is. That's if you can't prove your income or, you don't make enough money, so on and so forth. That's a no.
You can have a lower credit score too, right?
No,
No?
you can't. You can't.
I thought it was
have a
like
lower
600.
No.
They have financing down to like 640, but you're putting like 35 to 45% down
45%,
in those
and,
cases.
and then the rates are going to be generally high, so it's not going to debt service.
The one exception is the recent Freddie Mac product that came out for multi-units where there's a 5% down program.
That's a full doc.
Yeah,
right.
but it's income based. Yeah.
Right. So then, it's both actually, right?
But you can use the rental income to qualify
correct.
for it.
So now, if you can, like Ross was saying, if you can prove your income and you have relatively decent credit, you can go out, use the Freddie Mac program, Freddie Fannie program, put 5% down, and then you could use the cash flow of the home, whether it's a 2-unit, 3-unit, 4-unit, to qualify for it.
And that's restricted to 2 to 4 units.
2 to
correct?
4,
Yeah, so
correct.
Can't do it on just
Now,
single family or condos.
The other thing that Ross said, which I agree with, was that if you're going to go that route, you might as well, even if you want to get multiple units, then go out, get a 2-unit as your first primary residence, rent yourself the bottom one, live in it, and then rent up the top, or do the opposite, whatever. You stay in one, you rent the other. You're cash flowing, you're learning how to become a landlord, and then you repeat. You move out to that second unit, rent that out, you've had enough experience, and you go buy another 2-unit or 3-unit as your primary. You get in with anywhere between 3.5% to 5% down, and you just do it that way. That's the best way to do it.
Okay. What is house hacking, and is it a good strategy for beginners?
It's the same thing.
If you can go, you're just talking about it.
So house hacking ties in with the last two questions. You basically buy a property as your primary. You turn around, and you put a tenant in it. You go buy another primary. You put a tenant in it. You go buy another primary. As long as those properties cash flow for more than your mortgage payment, that income or that payment doesn't count against your debt to income when qualifying for the next house. And if you have residual income, depending on how long you've had that as a rental property, you can use that income to enhance your personal W-2 wages to qualify for an even bigger house. And so that's the number one strategy for house hacking. And for part-time investors or people who don't want to fully get in there, roll up their sleeves, swing hammers, deal with, the hard stuff that real estate investors have to do day in and day out. It's a great way to just, scratch the surface, build up your property count. The more doors you have, ideally over time with appreciation, you'll build more equity. You'll be able to tap that equity in the form of cash out refis and then use that equity to go out and acquire more properties. So if you want to stay in your professional job and work your 9 to 5 Monday through Friday, or you just don't have the time to go out and apply it as a real estate investor, that's a great way to get started.
How do I find off-market deals for real estate investing?
DustinWholesales.com.
Yeah, there you go. There you go. DustinBuys.com, DustinRingCoaching.com. The best way to do it is, first off, build a brand. Start in your backyard. Start locally. Start shouting it to the moon. Start telling everyone what you're doing. Hey, I buy houses fast for cash. Show up to the real estate meetings in your town. Tell your mom, tell your family, tell your friends. get business cards, start sending mail, start getting bandit signs, those signs you see during a political season when it's time to vote. Wherever the candidates are on, so I call them bandit signs. Start putting those out on polls. Start putting them out in rural areas. Start cold calling. You need to start working on your cold call skills. I mean, the best way to find off-market properties is to be direct to seller, and the only way to be direct to seller is to be direct to seller. Whether that's knocking on their door,
Farming.
Well, yeah, whether that's knocking on their door, whether that's leaving a note on the door, driving around looking for houses with tall grass, or essentially just farming. I mean, it's a numbers game. So if I send out 10,000 letters and 10 people say, "Yeah, I want to sell my property," then that's the name of the game. Marketing. You get really good at learning how to find good off-market deals without having to go to a wholesaler. That's when not only can you assign the stuff that you don't want, but you can cherry pick and keep the really, really sweet deals yourself. Those unicorn properties, those properties you'll probably never get rid of, or if you do get them, you can sell them for double or triple of what you bought them for. So there's many ways to get in front of sellers. Texting, I do billboards, I do radio commercials, I do TV commercials, so there's a lot of different ways to get in front of them. But if you're starting out and if you don't have a lot of money, driving around, leaving notes on doors, door knocking, man, getting dirty, man, guerrilla marketing is what I call it. Going out and getting dirty.
A lot of people want to see you also, right? I mean, you form that fucking connection.
Yeah.
And there was this guy, like I said, back in the day in the 90s, we didn't call it wholesaling. He had a company called Vernon Homes, okay? He called it Vernon Homes because he was on Vernon Avenue in fucking Brooklyn. This motherfucker, any house that went on sale on Vernon Avenue, he got first crack at it. Why? And this was, it's not like a fucking small street. This thing is long. And, it ran from Bedford Stuyvesant to the Bushwick or whatever the fuck it was. Anyway, and any house that went up for sale, he was so active on Vernon Avenue that he would get the first call. I mean, he had a lockdown on one fucking avenue, which is crazy.
For those people who do not have the time to go out there and become a wholesaler, I'm going to give you one of my secrets to finding off-market properties. How many people do you know in your network that are real estate agents? I've got a few family members and a lot of friends that are real estate agents, and they go into listing appointments all the time. And people want to list their house and get top dollar, but the house is just trashed. It's not ready for market. It's not, something that you can list and get top dollar for. So a realtor has a fiduciary duty to act in the best interest of the client. So you give them the option. We can put your house up for sale as is, and it's probably going to sit on the market for a while, and there's very limited buyers that are going to offer you something. You're probably going to get lowballed. You can put the money in and renovate the house and get it to, listing standard, and then get top dollar for it. But most people don't have the money or the time to do that. Or I got somebody, his name's Ras, who has cash, can come in and offer you something. It might not be the most attractive offer, but you're not going to have the 6% real estate commission. You're not going to have the title services fees and closing costs that you would have on a traditional transaction. So while it might be 10% below what the as-is market value is, you're probably going to net right around the same, and you're not going to have to sit there and wait for an offer. And so what I do is they'll kick me deals all the time where, like, this house is a hoarder house. And, like, I'll come in and I'll be like, I'll pay this for it if they'll take it. And surprisingly, most of them will take it, as long as I can work with them and give them the certain amount of days they want to move out. It might be 45 days. It might be, they want to live in it rent-free for a couple months post-possession, or they want me to deal with the junk out and all the other stuff. But those are the best deals I've found are just listing appointments that my brother, my mom, my sister, my friends have gone into, and they're like, I can't sell this property, help me out here. But they have to present to them all the options. As a wholesaler, you don't have the fiduciary duty to do that, so you can go straight in with an offer. But as a realtor, you got to be a little bit more cautious. But for the realtors out there listening, work with people like me that can help you provide liquidity to your client and offer a value and a service. For people who are looking for off-market properties, go out to your network of real estate agents and let them know what you're looking for, and be prepared to step in and close on that deal if they present you with something. Because just like every other thing in life, if you execute, you build trust. If you waste people's time, they're never going to come back to you. So make 100%. Sure you're in a position, you understand you have your financing lined up. You can close on that deal if you say you're going to do it. but it's a great way to get off-market deals and not have to do drop a sweat to get them.
Nice. Last question. What are the tax benefits of investing in real estate?
What are the tax benefits of investing in real estate? There's a number of them. The most important one that you're going to learn about is going to be depreciation on rental properties. You can depreciate a significant portion of the value of that property in the first year that you acquire it and use that to offset current year income. So as somebody who both flips houses and owns rental properties, I will buy rental properties to take depreciation to offset the gains on the properties I'm flipping. And you'll need to talk to a CPA to see what percentage you can depreciate and how that works. If you sell it down the road, you do have to pay taxes on the gain between where you depreciated the asset and where you sold it. But on my rental properties, I'm in a long-term hold. If I have to sell one of my rental properties, another tax benefit is a 1031 exchange. Instead of paying taxes and capital gains on that property that you're selling, you can acquire a similar like-for-like property, move the profits into that, and avoid taxes. A couple other areas, opportunity zones are another one where there's tax benefits. Opportunity zones it was a rule that was put into place, I think in 2018 or somewhere around there, where they identified areas that needed gentrification. And if you acquire and hold a property in an opportunity zone for 10 years, you mitigate all capital gains taxes. That is sunsetting, I think, at the end of this year. Depending on who gets elected, it might get extended. I'm not 100% sure, but just look up opportunity zone laws to get some more backstory there. And then the other one is related to consumers and owner-occupant properties. There's a couple of benefits there. There's a mortgage interest tax deduction where the interest you pay on your mortgage is deductible up to a certain amount, which helps offset your tax liability, for your traditional W-2 wages. And then there's also, depending on how long you've owned your primary residence, when you sell it, you do not have to pay capital gains on that. And I believe it's 3 years, to do that. And you can even sell it after you've moved out, I think up to 2 years, even though you used it as a rental. I think if it sells within year 5, you still mitigate capital gains taxes. So that's one of the really smart ways to do it is, leverage the mortgage interest deduction on against your personal income for your primary. And then if you want to move out of your primary, you can rent it for a couple of years, still sell it, avoid the capital gains taxes, and still earn that rental income during that period of time. Outside of that, you guys got any other tax benefits?
Cash out refinance. So basically, instead of selling the property, you're going to pull out as much equity as you can without selling it, and you don't pay $1 worth of tax on that. And that's one of the most powerful tools that you could get. It's completely tax-free.
Because it's a loan.
Yep.
It's a loan, correct. But you're getting the cash in hand, and you can do whatever you want with that cash, and it's completely 100% tax-free.
And you actually have a higher interest payment now, which gets deducted against your rental income. So you pay less, you make less rental income on a cash flow basis, but you're paying less tax on the rental income on that property, and you're stripping that money out in the form of cash out proceeds. So you end up mitigating taxes by doing a cash out refi because your expense load goes up, so your profit margins are thinner, and then you get all that cash flow from the cash out refi to go out and buy more properties.
Beautiful.
That's it. Well, this is the end of this episode. Make sure that you like at the bottom, share, and if you have any questions that you may have, please type in the bottom and we'll make sure that we answer you. You've been listening to The Game of Loans, where real estate battles are fought and won. Make sure to fortify your defenses by subscribing. Cash flow is coming, and we'll be back next time to help you claim your throne. The war of wealth continues.